Hello, welcome to Express Notes. This is the ACCA Paper F6 UK Taxation. Welcome. Now, one of the questions you might have is, what are Express Notes? Well, Express Notes are what we believe to be the key parts of the syllabus that we're going to need to cover to get through the whole of the syllabus. There are quite a few chapters, some longer than others. These recordings are meant to be around 10 minutes and no longer, and I will try and keep you to that, and I will highlight key points and explain slightly more difficult and complicated areas. Okay, what are we going to look at? Well, here are the contents about Express Notes: the introduction, income tax and capital allowances, trading income through trading losses, property income, investment income, pensions, national insurance, corporation tax, chargeable gains, capital gains, inheritance tax, and finishing with VAT. Quite a few chapters, quite a lot to get through. Let's crack on. Okay, first of all, the sort of disclaimer, as we always do in these sort of things. Please note that these notes are not designed to cover everything in the syllabus. Okay, they are meant to be a synopsis of the syllabus, albeit there's 18 chapters. So let's keep going, but that's just, do remember that it's not meant to be everything. Okay, so chapter 1, introduction. The big picture is kind of how the Express Notes are written. I'm going to carry on with that principle. What we're going to look at here is the core principles of taxation in the UK. This is the paper that mainly computational, and there are 5 compulsory questions in the exam. Taxation can get quite complicated, quite detailed computational questions, lots of little rules to remember. You must have a good understanding of the core areas of taxation, therefore that candidates understand the key areas. Don't get too bogged down in the detail. Okay, what are the main areas? Well, income tax, that's payable by individuals. Corporation tax, that's payable by companies. Capital gains tax, payable by individuals. Companies pay corporation tax, please note. VAT, that's payable by both companies and unincorporated businesses. National insurance, not strictly a tax but payable by individuals and employers. Okay, it's not just individuals that suffer national insurance, it's like a social security cost. Question 1 in the exam will focus on income tax, and question 2 will focus on corporation tax. Paper F6 has a comprehensive syllabus. We're going to give you guidance on core areas. Taxation legislation can change rapidly. These notes are designed to provide assistance for students taking the exams in 2012. These notes should not be used for any other purpose. Please note that the exam, although it's for 2002, pretty much 2013 can be the same thing. Okay, that's chapter 1. Chapter 2, a bit more interesting. Income tax, introduction. It will be examined. Individuals who are UK tax resident will be taxed on their worldwide income. Okay, so it's not just what they earn in the UK, but also property abroad, for instance, will be taxable in the UK. The period of assessment is the tax year. The tax year in the UK runs from 6th of April to the 5th of April. So a little bit quirky. A lot of countries have February year ends, March year ends. We have 5th of April year end. It runs, say, the 2011-12, which is just finished, on the 5th of April 2012. All of an individual's income arising in the tax year will be assessed in that tax year. Pro forma tax computation, very important to remember this. So for 2011-12, that ends 5th of April 2012, you add up all your income. So you can have income from your employment, salary, Trading income, so that's unincorporated businesses. Property income, that's rental income. Bank dividend in the UK is paid net, so you have to gross it up by this 100/80 calculation. UK dividends, it's 100/90. There's an assumption that 10% has been paid at source to give you your total income, in this case 42,000 example. There's some reliefs which we'll look at later. Net income, important terminology, that's their net income after some reliefs. Personal allowance, that's effectively your tax-free amount, and that changes every year. For that year 11-12 it was 7475. Gives you your taxable income, very key terminology. So that's what you're going to pay tax on. There are some exemptions which are listed there. Personal allowance, everybody's entitled to that, but you cannot set against any other liabilities such as CGT, capital gains tax. Personal allowance is deducted from an individual's income to give taxable income. From 2010-11, there was an introduction of legislation where if you earned more than 100,000, then your personal allowance was reduced by something called ANI, adjusted net income. How do you work out your ANI? Well, basically it's net income less gross gift aid donations, so gross again, but any gift aid that you do, gross personal pension contributions, and that gives you your ANI. If ANI is greater than 100,000, the personal allowance is reduced by 50% times ANI minus 100,000. Therefore, individuals with 114,950 do not get a personal allowance. Personal age allowances. This is for someone who's aged over 65, also over 75. You get a higher personal allowance. However, if a person is entitled to a personal PAA has ANI above 24,000, the PAA is reduced by, and here we go again, the same sort of formula. You will always at least get your 7475, but if your ANI is above 100,000, there'll be a reduction in the personal allowance as before. Income tax liability. Well, once the taxable income has been calculated, your taxable income, the basic rate is 1 to 35,000 of taxable income is at 20%. Higher rate is at 40%, between 35,000 and 150,000 of taxable income. And above that it's 150,000, it's all at 50. Income tax on dividend income is either at 10, 32 or 42.5, and this is an important table to remember, which you will remember over time, but please note it is provided in the exam. Please note that if your income goes slightly over the personal allowance, the first 2,560, if that is savings income, then it is taxed at a lower rate, which is 10%. Okay, that was the basic introduction. We'll now go on to chapter 3 in the next recording.